Hello students, welcome to Costing Methods and Techniques class. Today's class we are going to solve a few more problems on marginal costing. So here is the problem. Akashvani tape recorder company sold 5,000 radios last year at a price of rupees 1,000 each. The cost statement is as follows. So materials, wages, variable cost, then total if you make, you'll get marginal cost. Add factory overheads, total cost is 750, profit is 250 and selling price is 1000. Due to heavy competition, the price will have to be reduced to rupees 850 in the coming year. Assuming no changes in cost. Calculate the number of units that should be sold at the new price to get same total profit as in the last year. Now here whatever information they have given, this is per unit information. Okay. Now Akashvani tape recorder company is selling 5,000 radios. Okay, and the selling price is 1,000. Profit is 250 per radio. Okay, now first what we will do, we will find out the profit of last year. Okay, so profit. Now how many radios they have sold? 5,000 radios into profit per radio is rupees 250, which is given in the chart. So that will be equal to rupees 12,50,000. That is equals to 12,50,000. Okay. Now they have asked us to find out how much is profit. Okay. Calculate the number of units that should be sold at the new price to get same profit. Okay. So to get same profit, we need to find out how much is the selling price. Okay. And to calculate that, like to know what is the selling price, that is amount of sales we need to find out. Okay, when profit is 12,50,000, because they are going to earn same profit in the next year also. So their profit for the last year is 12,50,000. Okay, so amount of sales we need to find out. So to know amount of sales, first we should know what is fixed cost, because fixed cost is not given in the problem. Okay, now profit will be 12,50,000. PV ratio is also not given in the problem. So PV ratio we need to calculate, as well as fixed cost has to be calculated. Now fixed cost, what they have given, like fixed overheads of 400 per unit. So that itself we will consider as fixed cost, but this is per radio. We need to find it for 5,000 radios. So 5,000 radios into rupees 400. So that will be equal to rupees 20 lakhs. That will be equal to 20 lakhs. Next we will find out PV ratio. Okay, now PV ratio is sales per unit minus variable cost per unit divided by sales per unit. Now sales per unit we know. Okay, now what they have given sales per unit is, check here, due to heavy competition, the price will have to be reduced to rupees 850 in the coming year. So in the coming year, they are going to reduce it to 850. So our selling price will be 850 per unit minus variable cost. And even they have given like whatever cost, assuming no changes in the cost. So cost will remain same. Okay. So variable cost per unit. Now variable cost, go through the problem. Okay, they have given us the chart. So what we will do, this we will assume marginal cost as variable cost, because materials, again, it depends on like how much you are producing and how much material is required. So it keeps on varying. Even wages, it keeps on varying, and variable overhead. So total of these 350 we are going to take it here. So minus 350 divided by selling price is 850. Selling price is 850. Okay, so that will be equal to 0.59. 0.59. Okay, now we need to find out profit. So total number of amount of sales is equals to fixed cost plus profit divided by PV ratio. So that is equals to fixed cost already we have calculated, that is 20 lakhs plus profit is 12 lakh 50,000 divided by PV ratio. PV ratio is 0.59. Okay, so that is equals to 55 lakhs 8,474.5. This is amount of sales. Okay, now we will find out profit amount of sales per tape recorder. So number of tape recorder (55 lakhs 8,474.5) divided by selling prices 850. So that is equals to 6,480.5 tape recorder. Okay, hope so this problem is clear to everyone. So what we have done, we have calculated first profit, then we have calculated a fixed cost, then PV ratio, and then amount of sales, then how many tape recorders they have sold. So they have sold 6,480 tape recorders. Okay, so go through the problem and solve it. Now another problem we are going to solve. So I'll read out the problem. Swati company provides split up of the cost as below. Particulars and rupees, and this rupees is per unit. Direct material, direct wages, variable manufacturing overheads, commission per unit sold, selling price. Fixed factory overheads are rupees 1,60,000 and fixed selling overheads rupees 20,000. Find BP in rupees and number of units. Second one is to earn rupees 1,20,000 profit, how many units must be sold? Next is find margin of safety at rupees 20,000 units at rupees 40 each. Okay, yes. Now they have asked us to find out BP. in amount as well as in units they have asked. Okay, so for that we should know what is PV ratio. So first we will find out PV ratio. So write down PV ratio formula, that is sales per unit minus variable cost per unit divided by sales per unit. Okay, now sales per unit is equals to say 40 minus variable cost. Variable manufacturing overheads is given. Now variable cost, what we are going to take is, now 10 is direct material, direct wages is 4, variable manufacturing overheads is 8, and commission per unit sold is 3. So we will have to add all these. 25 it will be. 10 plus 4 plus 8 plus 3, because it depends, variable cost, it depends on production. So these all expenses will be relating to production. Sometimes if production increases, these expenses increase. Sometimes if the production decrease, these expense will also decrease. Okay, so accordingly we need to add it and take it. So that is 25 units, sorry, 25 rupees divided by selling price is 40. So that is equals to 0.375. 0.375. Okay. Yes. Now this is PV ratio. Now we will find out BP in amount. Now formula is what? Fixed cost divided by PV ratio. Now fixed cost is being given in the problem. Now see here, fixed factory overheads are rupees 1,60,000 and fixed selling overheads are rupees 20,000. So add this, that will be 1,80,000. 1,80,000 then divided by PV ratio. PV ratio is 0.375. Okay, so that will be equal to 4,80,000 in amount. So we need to find out BP in units. So how we will find out BP in units? So amount is 4,80,000. 4,80,000. Okay, so divided by selling price is 40. So that is equals to 12,000 units. Hope so everybody is understanding this. Next we are going to find out, read second point what they have given. To earn rupees 1,20,000 profit, how many units must be sold? Okay, so profit, to earn 1,20,000 profit, how many units are sold, that we need to find out. So for that we will apply amount of sales formula. So that is equals to fixed cost is 1,80,000 plus profit they have given is 1,20,000. So to earn 1,20,000, how much will be your sales? So we are applying this formula. So you should know when to apply which formula. Okay, now PV ratio already we have calculated 0.375. Okay, so that is equals to 8 lakhs. That is equals to 8 lakhs. So next we are going to see number of units is equals to, it is 8 lakhs divided by selling price is 40. So that is equals to 2000 units. Okay, so to earn 1,20,000, they have to sell 2000 units. Okay, now next go through the problem C, which is third point. Now find margin of safety at rupees 20,000 at rupees 20,000 at 20,000 units at rupees 40 each. Okay, so write down margin of safety formula, profit divided by PV ratio. So profit is 1,20,000 divided by PV ratio is 0.375. So that will be equal to 3,20,000. 3,20,000. So margin of safety is 3,20,000. Okay. Hope so this problem is also clear to everyone. Please go through the problem, solve it again, and go through the formulas whatever I have given, because if you know the formulas only then you can solve the problems. Okay. So in next class I'll be completing your fourth unit. Okay. So see you in next class.